Introduction to Agro Value Chain Finance, Case Study Georgia. We are fortunate to be joined by Tyler Green, a project coordinator for BC. He is currently working on the ground in Georgia on value chain finance projects. His presentation will last around 15 minutes, followed by a question and answer session. The whole webinar should last around 45 minutes. Please note that the presentation will be recorded, but not the discussion. Tyler, thank you very much for being here and agreeing to share your experiences and insights.
Thanks, Marina. So as Marina said, my name is Tyler Green. I'm working on value chain finance here in Georgia, and I'm here to show you a short case study. So, a quick profile about the country of Georgia. It's made up of 3.7 million people in Eurasia. The major industries: agro, foods, wines, energy, and tourism. And its main trade partners are Russia and Turkey, as well as other Eurasia and European countries. Why we picked Georgia? BFC has been in Georgia for a long time. They have very strong relationships, have great experience, many success stories, and a lot of projects have been implemented here. To look at the Georgian agriculture sector in general, we see that it makes about 9 to 10% of the GDP for Georgia. However, it employs about 53% of the total workforce. So it shows that there's a lot of room for growth in the agriculture sector here in Georgia. Looking at the agriculture products specifically, biggest is potatoes, grapes, also followed by other fruits and hazelnuts, which we'll speak about later. For the PFI project, we have two components. We have access to insurance and access to finance. We have many different objectives. However, the objective we're going to concentrate on today is the establishment of value chain finance here in Georgia. So when we look at the term value chain, there are many different definitions. For example, World Bank sees it as value-adding activities. UNIDO sees it as the connection of different actors, where CIAT sees it as a strategic network. What is a value chain in our eyes? We see it as a system of economic cooperation that stabilizes output and income, it lowers costs, and increases quality. So for agriculture value chains in Georgia, we begin with input suppliers and service providers, moving to the farmers, which then goes to processors and distribution centers, then to wholesalers, and eventually to the consumers. Now, value chain finance is taking this value chain, and in Georgia we are concentrating on connecting the three initial steps of the value chain: suppliers, farmers, and processors, and creating one financial product that finances them all throughout the value chain. Then we moved on to selecting value chains. What we were looking for was value chains that have import replacement potential, export potential, the ability for small farms to have a rate of return, the ability for small farms and processors to grow, and the ability for financial institutions to also have a return on investment. We had to pick value chains that would get the attention of the financial institutions. So then we moved on, we selected 4 value chains based on growth potential, volume, and their competitiveness. We chose dairy, potatoes, livestock, and hazelnut, which we found has the highest growth potential. We then pre-screened many different processors and input suppliers throughout Georgia. We pre-screened them by having a large amount of farmers, having a significant revenue to attract the financial institutions, having direct relations with their farmers, having a high dependence on their farmers, having information on their farmers, and being willing to provide that information to the financial institutions. And lastly, a history of growth and willingness to continue to grow in the future. Once we pre-screened, we then went further and we screened many other processors, interviewed them, and then we finally selected value chain finance partners, where we screened 24, interviewed 15, and now we currently are working with 7 different value chain partners. To summarize these partners, we have 2 partners working with hazelnuts. We have 1 with dairy, 2 with livestock, 1 with potato, and 1 multi-value chain finance scheme where through 1 partner, we can finance the inputs of all of the value chains in our project. So now to dive in on one of the value chain schemes, we have selected the Georgian Hazelnut Growers Association, GHGA. They came to us with their needs. Basically, their information they have is they have 1,050 tons of hazelnut produced per year. It's made up of 700 different farmers. They currently have 3 drying facilities, and they have 1 storage facility in northwest Georgia, which can hold 500 tons of hazelnut. More information about the association. They are supported both financially and with technical assistance from USAID, from Agro Georgia, and from Ferrero. So this association has a lot of support, and we're expecting it to grow very big in the next few years here in Georgia. What they expressed their needs to us were input supplies for their farmers, cash for the harvesting fees, money for the processing fees, and a warehouse receipt loan scheme to have cash on hand at the time of harvest. So we took all of their needs, and then we developed a value chain finance scheme that we thought would be good for them and also attractive to the banks, which we can look at now. Where we have 5 different actors. We have the association, we have the input supply company, the financial institution Crystal, the farmers, and the buyers. So to begin the scheme, we created partnerships with the association and partnerships from the association and farmers. So association and financial institution creates a partnership, and the association provides information from the farmers, such as land size, plots, past production, and expected production. Based on this information, Crystal was able to process loan applications at a faster time using less processes, and then could form agreements with farmers that want to participate in the scheme. Once the agreements and accounts are opened, it's time to do the production cycle. So, Crystal gives the first loan to Cartulisi, which is the input supply company, in February or March. Then Cartulisi provides supplies to the farmers, where the loan amounts will be opened up on the farmers' accounts in Crystal. So there will be no cash exchange from farmers to Cartulisi. Then when it comes time of harvest, Crystal will give a cash loan to the farmers to pay for their harvesting costs. After harvest, farmers will give their hazelnuts to the association, where they will be dried, cleaned, and then stored correctly, which is a problem in Georgia, and this will increase the quality of their product. Once they've stored these hazelnuts, they'll receive a warehouse receipt, which will state the amount of hazelnuts and the quality of hazelnuts that they have stored at the association. Then they will use these receipts as collateral against their hazelnuts for Crystal. We'll then give them a loan, which represents 50% of the value of the hazelnut that they had stored in the association. This is important for farmers because this is in the fall, so they need money for just living expenses. A lot of them have children to go to school, so So this was an important part of the scheme for them. Now, next step is the farmer will sell the hazelnuts to the buyers when the price is best for them. The buyer will make payment not to the farmer, but to the farmer's account in Crystal. Then Crystal will transfer the payment that was made to Crystal for the farmer minus the loan plus the interest, minus the loan and interest combined, which means it reduces the overall risk for Crystal, makes the process more efficient. To see it again in a different financing structure based with the months, you have the first loan, which is February and March, which is for fertilizers, and throughout the season they keep receiving nitrates and plant protection. Then it will be harvested. They will receive the second loan to pay for harvest costs. They will receive a third loan based on the amount and quality of hazelnuts that they have supplied to the association. With this, they can repay the first loan, and then the hazelnuts are staying in the association warehouse until prices are high. When the farmer decides they want to sell, they sell their hazelnuts, and by March will be time to repay the loans. We then created main parameters for the loans, purposes of the loans, the amounts, maturities, payment schedules, and collateral. A little more technical, but it was good to use for the financial institution for Crystal. Then we worked with Crystal on the business process for the different types of loans. So we have 3 loans. First, we created a business process for input supply and harvest cost loans. We then created the business process for the warehouse receipt loans, which you can see we are decreasing the processing times and efforts of Crystal, which is important to the scheme. Which then takes us to the benefits for all stakeholders. For the association, it increases the quality of the hazelnuts, which is their main objective. And as this increases, they will increase the number of its members in the farmer base. For the farmers, they get increased production, increased quality. They have now guaranteed drying and storage facilities, which they didn't have before in Georgia. And they also have lower interest rates on their loans, which is because of the assistance we offer Crystal. We decrease their operational costs, which decreases interest rates. We decrease the risk, improve efficiency, and we also open up additional sales channels for Crystal. So that is the end of the case study for value chain finance in Georgia.